Well, hello and welcome to our latest live stream session. Martin North here from Digital Finance Analytics. And this is the pre-chat, as it were, to see who's on. Hopefully everything's running well. Hopefully, fingers crossed. John Adams is here. Help Australia get its gold back. Hello, John. Good to see you. Gun Pilot. One DS Champ, I'm lost. Robbie Zero, sorry. Tony 007-ish, very good. Illuminati, hello. A few others there too. Stephen Shaw, daylight saving almost got me. Ah, yes, that's a problem, isn't it? But, hello, mate. Chris Zero Tube, Ron Skerritt, the Bloghead, Richard Girl. Shut up, you can buy. Very good. A little bit. Very good. Got quite a few on. That's great. John Adams, you're getting a lot of praise for your efforts over the last few days with regard to gold, so that's great. Okay. Yes, he's a legend. I agree. There's a whole bunch. Michelle, Claire, Adam Jacob, Lazy Postman, Josh. Greetings to you all. I may have missed a few in the process. Sorry about that. Hello, Peter. Hello, Ken, Dale, Average, Clive, Gary. It's good to see you all. I really appreciate you coming on and joining me today. I'm just going to run this for another moment or so, and then we'll get the formal show underway. Bankers make money out of nothing, says everyone. Yeah, correct. That's exactly right. Magic loans out of nothing. It's a very simple process once you understand it. Wendy's there. Paradigm Shifter, hello. Watches Slow 6 weeks ago. Show 6 weeks ago. 6 grams of silver. Okay, very good. Now, just to explain, once we get going formally, I'm going to just run through the normal stuff, and then we'll go into a full Q&A. Okay, so I'm just going away to start the show. See whether it goes. See you in a minute. Well, hello, welcome to this live stream event on the 16th of October 2018. Great to have you on board, and we've already got a whole bunch of people joined us. That's great to see. So it's really quite exciting having this all happening live. It's Martin North, of course, Digital Finance Analytics here, and this is the fourth or fifth one we've run, and the last few I think have been quite successful, so I hope this will be too. What I'm going to do first of all is just going to go through a few initial points, and then I'll pick up the chat. So just so you know, I'm not going to keep looking at the chat. Last time it got a bit confusing because effectively I kept looking to see what people were saying. So if you have questions or points to make, then you can make them, but I'm going to read them after I've just gone through the quick introduction here. So it won't take long. Hopefully all working well. Just so you know, I'm streaming at 1080p, 6 megabytes across NBN. Seems to work quite well. Okay, so the running order, just this introduction, which we've done, just some house rules. Talk a bit about our models and why this is a fundamental part of what we do. I've just a few key slides, just one or two, just to get the juices flowing, and then we'll go into Q&A and happily to answer anything I can. If I can't, I'll tell you. If I need to take questions and notice, I'll tell you that too, and then we'll sign off. I reckon this will probably run for an hour, but on past experience, it may be slightly longer than that. We'll see how we go. Now, just in terms of house rules, a few quick things. Please note, this is not financial advice. I'm not qualified to give financial advice. I can't tailor what I'm saying to individual circumstances, so please don't take it as that. This is just my opinion based on a bit of research that I do, but it is not financial advice. Please play nice in the chat room. It is being moderated. We have had a few issues, but not many, and hopefully that'll stay. So many really intelligent comments and observations that it's a pity to mess it up with just a few weird ones. This is, of course, as at today. If you're watching this post in the live stream recording, it was recorded at 16th of October 2018, the day when the Australian Stock Exchange bounced up a little after the shenanigans over the last few days. If you want to get my attention, please do use the app Walk the World. It's the best way to make sure that I actually see what's going on. I won't necessarily follow all of the conversations because there are many, many conversations going on. But if you use Walk the World, it'll try and get my attention. I have not turned on the super chat. Somebody suggested that the last time. We might consider that down the track, but I'm going to continue to use the method that I have in the past. And so with those quick points, just this is the model, this is my universe, this is the way that I think about the world. So I have all of my survey data and data from other sources. I have the industry information and also information from the various banks and other organizations that report. That all goes into my core market model. That's where I do all my scenario modeling and economic analysis, and that then feeds the industry reports, the various other things that I do, and all of the stuff on the blog and all the stuff on YouTube. Looks so simple, but actually it's quite a complex process. But that's what I've been doing it for 15 years now, and the model is updated every week as we get new survey data in. And we can slice and dice the data all sorts of different ways, across segments, across locations, across different property statuses, and lots of other things too. We've got 140 plus different dimensions to the modeling. So just quickly a few slides. The RBA minutes came out today. Didn't tell you much that you didn't know already, but they did actually comment on the slow decline in house prices. In fact, they said house prices have declined noticeably in Sydney and Melbourne. Well, that's telling us something we don't know. And they're also talking about further tightening of lending standards are possible, although, as they say, competition for borrowers of high credit quality remains strong, and that's exactly right. So if you are the right sort of borrower with the right sort of loan-to-value ratio and the right sort of income, loans are there and very cheap. If you're not, tough luck. And it's also just worth observing their comment about the global situation with regard to global inflationary pressures rising, few central banks, including the Fed, lifting rates. And of course, they also mentioned the fact that the modest depreciation of the Australian dollar is likely to have been helpful to domestic economic growth. So basically, they're signalling, I think, their ability to let the dollar go lower. And they keep talking about the next rate move will be up, but not for some time. So we'll see whether that eventuates. Just in terms of a couple of other charts, so credit growth is slowing. It's 5.4% annualized according to the RBA latest data. 5.4 still quite strong, but it's dropped quite a lot. But of course, it's interesting to note that the investor loan is really, really, really sliding. So it's 1.5%. The owner-occupied lending is still growing quite strongly, but there is signs that that's easing. And in fact, the data that came out today, which is the final set of data from the ABS, showed considerable slide, particularly investor lending, but also in other sectors too, and not just in Sydney and Melbourne, but nationally as well. Mortgage stress, as I keep reporting, is still rising. 30.6% of households are actually in mortgage stress. That's a record, more than 1 million households. The debt-to-income ratio is 190.5 according to the RBA. That's an all-time record. So we have high debt. We have high household mortgage stress, not least because costs are rising very fast, incomes are not rising. And the final point to make there is that the future trajectory for this looks as though this is going to continue to rise because debt is still rising, as we showed in the earlier chart. BBSW pricing, so this tells you a little bit about the fact that there's still pressure in the banking system from overseas funding, 17.5 basis points from its lows back in February. That's still enough, in my view, to warrant the banks probably putting some rates up later. But of course, they're also fighting for that low-risk loan business at the moment. So we'll watch for some differential pricing, I suspect, going forward. And just to quickly think about house prices, so in the good old days when the market was buoyant, you could think about price discovery. In other words, there was an auction and you'd see where the price point was. Now you can't do that. You've got to think of it bottom up from the land and utilities and fees and from the construction costs and inputs, and maybe some amenity value if it's on the coast or if it's got great views or something like that. But there's a considerable gap, and that's on average 40% across Sydney and Melbourne, and a little bit less in some other places. But effectively, we're continuing to see home prices slide, and my view is that will continue. We'll talk about it a bit more in a moment or two. And of course, just to make the point, there's a bunch of downward pressures on this whole situation and why home prices will fall further. Lending standards are tighter, mortgage borrowing powers dropped, foreign buyers have dropped, there are more self-managed super fund restrictions, the interest-only borrowing has been restricted, and there's also the refinancing of those. Investors are less likely to transact, as I showed in some of my earlier posts. Tighter returns on rentals, about half are underwater. It's actually getting worse, particularly in Melbourne and Victoria. Higher interbank funding costs, as I showed a second ago. Rising mortgage costs and rates, although of course NAB did hold. I wonder how long that will last for. And there's also now even more risks from class actions and Royal Commission issues. And of course, NAB was the latest today to declare an extra 300 million plus of costs to remediate customers who've actually been poorly served in the past. So there's a whole bunch of additional costs. There's more than $1 billion now going out from the banks. So they've got funding pressures and also they've got profitability pressures, etc. So this is a very, 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 very tight situation. So that's why I'm arguing that home prices will continue to fall further. Now the question is how much further, and that takes us directly to our scenarios, because out from our model we can actually produce the scenarios, and the scenarios basically allow us to explore different ways of thinking about where the future may go. So we used to have 4 scenarios, but now we've added a 5th. This is really partly thanks to John's input. So we now have a 5th scenario too, and briefly I'll run through them. So basically we've got the business as usual scenario, which is where we start, and then we've got things going to get better, not yet doomsday. The Armageddon one, which is the one we had before, which I've called Ireland 2.0, and now we have Doomsday, which I call Iceland 2.0, and we'll explain that in a second, or as John would want to call it, Hell on Earth. He's a gloomy old guy, is John. Okay, so this is the latest scenario. So basically, this is the business as usual. This is the one that most of the economists in Australia are saying are likely to play out. I now give this a 3.5% probability. It was 5% last time I looked at it a couple of months ago. Pretty much the same. RBA rate stays the same. Unemployment stays the same. Mortgage stress continues to rise. The bank losses rise a little. Home prices 10 to 15% over the next 24 to 36 months. And nothing really unnatural in terms of actually trying to fix that. So basically, if you leave it steady state, that's what you end up with as a minimum. Most of the mainstream economists are still holding to that view, but I think they're being way too optimistic. So the second one is what I call things going to get better. So this is where the Reserve Bank actually does lift rates. Unemployment rises a little, mortgage stress rises, the bank losses go up, home prices now 15 to 20%, and we see some easing of credit rules, particularly for some types of borrowers, perhaps lower risk borrowers. Now that's probably got a 35% weighting, same as last time, no real change. The next one is what I call not yet doomsday. So this is now again with a hike in rates, higher unemployment, higher mortgage stress, higher losses. But the difference here is we get more interference from overseas. So basically we've got things like rates in the US flowing through to higher funding costs and those sorts of things. And those funding costs and the inability to get liquidity when it's wanted could be sufficient that one bank may actually need to be bailed out. And I think there's a 40% chance of that scenario playing out. And home prices, 20 to 30% on average across Australia. Varies by location, type of property, but this is just an average. And then we go to Armageddon, which is used to be the worst case scenario that I had, where prices were 30 to 45% down. Here now we have international issues. We have basically disruption in the capital markets. We have credit issues and maybe international issues as well. And the critical point to note is that whilst interest rates are very low here in the 0.5 to 0 range, unemployment rises, mortgage stress rises, losses rise, and home prices could be 30 to 45% down. And there will be a number of bail-ins and a number of bailouts. That now has a 17.5% probability. And the last one, this is John's special, is what we call doomsday or hell on earth. And here we have 0 or below interest rates. We have unemployment rising much higher, about 18%, mortgage stress very, very high, bank losses astronomical, home prices down as much as 80%, and then there's quantitative easing and bank failures in the mix. And the point about that is that this is the difference between that and Armageddon is that in Armageddon there's bail-ins and bail-outs. In the doomsday scenario, there is not a bail-in and not a bail-out. So basically this is the one that John and I discussed a few weeks ago, which basically said if you don't bail in the banks and bail out the banks, this is what we could be up for. This could be the depression that essentially could play out. Now, in my model, that comes in at 4%, and you can see those two combined pretty much come up to the 20%, pretty much, compared with last time. Now, the point there then is that those are the different scenarios, and you can see my relative weighting, but that tells you that my midpoint view is now moved from being things only get better to not yet doomsday. So I'm looking at now over the next 3 years at least one bank needing to be bailed out, home prices down 20 to 30%. This is not looking very good. And as I say, if you look at the next two, they are now more in focus. And now when I run the model next time, we'll be able to see how that moves over time. So there you go. That's the latest update. It's not looking good. But most of those mainstream economists who are talking 10 to 15% down over 3 years, I think they're just kidding themselves. Okay, so with that introduction, hope that made some sort of sense. Now let me go back and look at the chat there, and I'll pick up some of the questions. I've also got a load of questions from people asking earlier on. There's a lot of questions about bail-in, so we'll cover some of those in a moment or two. I'm just seeing what else we have. A lot of other people have been making various comments. A lot of people saying hello, that's good. Hello again to some people who say hello again, that's good. Just seeing what else is there. Yep. So people are talking about Bitcoin. I'm lost. Martin North and Mike Martin is interesting coincidence. Yes, that's true. I'm lost. That's interesting, isn't it? Okay, I'm just looking down to see what the questions are, if any. Has anyone ever performed a calculation on CPA if land values still included in the calculation? Haven't done it myself. Good question, that, Simon. I don't know. And actually, the whole question is what is land worth is a really interesting question, right? Because you could argue that in a downturn, land prices will also slide, and it's a question of how much. My own view is that we will actually end up probably with some degree of sliding. The question is how much, of course. We just don't quite know, so that's the way it works. Okay, now I've gone through a few of the quick points. Let's try and see what other questions there are. Okay. Only floor on property prices and stock prices is diminished faith in the banks and the fiat system. We may end at the end. Well, yeah, it's interesting. Confidence is, of course, a lot of it, and a lot of the questions, I think, coming will be confidence-led, and that's why a lot of the property sector are very, very concerned about potentially the issues relating to levels of confidence. We don't want to talk about it because it may make it happen. In fact, if you saw the post from Edwin the other day, he was saying, you know, he gets accused of talking the market down, and I guess I do to an extent too, but frankly, I don't think we're talking the market down. I think, frankly, it's more to do with the question of what's happening. You know, we're just reflecting what's going on. Now, Clive has suggested macro business thinks the next RBA move is down. What's your opinion? No, I think my own view is that the Reserve Bank would like to put the mortgage rate up, but I don't think they will. I think they will end up essentially putting the rate down because effectively they will need to try and lift the economy a little. The problem is, of course, that the rate will not have a huge impact. So if you do lift the rates, that would actually put more pressure on households. But if you drop rates, it will hardly have any impact on households because I think it's unlikely that the banks will pass all of the cut on. And of course, it gives the Reserve Bank less wriggle room for later. And, you know, if John were here, he'd be talking about, well, there are different scenarios. You might see very low rates, you might see higher rates, you might see rates low and then high because effectively you're starting to print money again. So it really is a very, very a very, very unsure scenario. But my own view is the next move is probably going to be down, but not for the next sort of few months, I think. Now, said, hell on earth, sold. I'll have 2, please. Yeah, what size would you take? What size would you like? Is my question to that. Can we see the size as well? Oh, sorry, I realise now that I haven't actually shown you the slides. That was my fault. Okay, my apologies. That was because I got carried away and then didn't look at the chat. What I will do is I will now just move back to the slides briefly, and I'll just show you the critical ones, and then we can go on from there. My apologies for that. Okay, so we'll go to that one, and then we'll go to there. Hopefully that will work now. Yeah, my apologies. Okay, so that's my universe, research universe. And these are the scenarios. So that was business as usual as I went through. Sorry, I didn't show you this before. That's the things that only get better scenario. That's the not yet doomsday scenario. That's the Armageddon scenario. And that's the hell on earth scenario. So you can see the numbers there. Sorry about that. And you can see there I've got my sort of halfway line, as it were, centered just into the not yet doomsday scenario. So that's the tricky stuff. Previously, last time I ran the model, it actually was indicating probably on the borderline, but it's now moved further down into the not yet doomsday scenario. And what that means is that we are moving into this much more uncertain territory. Indiana Jones says, 5th scenario, Sydney becomes a slum, people eat animals at Taronga Zoo for food. Yes, it could be a little bit uncomfortable, I think. What scenario would you see bail-in being considered, said Ahmed? Well, look, I've said in my scenarios here that not yet doomsday, there is one bank who is perhaps a little bit more exposed than some of the other banks. And there is a chance that if things play out the way that we're suggesting here, particularly with international liquidity getting tight, that one bank may well need to be bailed out. Bailing in, I think probably we might have isolated failures, but I think it's more in the next scenario that bail-in really sort of ramps up. And I'll talk a bit more about bail-in because there's I've got a lot of questions prior to the session as well on bail-in. So I'll talk a little bit about that in a moment or two. Okay, so those are the scenarios. Apologies for not showing those to you earlier on. What I'll do is I'll put up a clean version of this stream as well, and I'll put the slides back in so people can actually see it if you're not in the live stream. But if you're in the live stream, sorry, it's my bad. I apologise for that. Trying to do everything myself, I sometimes forget to push a button. Okay, what else have we got? Okay. What should those with significant savings do, says Dancing with Fools. Now, that's a really, really interesting question. I think the first point I want to make here is we are talking some time ahead, right? This is not something which is going to happen tomorrow afternoon, right? So there is time, and I still believe there is time potentially for those in power to begin to react more positively and to think about these alternative scenarios and begin to actually put in place measures that could actually help to perhaps negate some of the worst effects. Part of the reasons for using these scenarios is to try and get those to understand that you can't just live as business as usual and hope that everything will be fine. There's only a 3.5% probability that that's going to happen now. There's much more likelihood that some of the other stuff is going to happen. So that's the first point. The second is then if you've got savings, the question is it about security of those savings? In other words, making sure that you don't actually lose value, or is it about trying to grow those savings? Because your strategies will be quite different, I think, depending on your outcome. And then you need to just sort of decide in your own mind which of those scenarios is the one that you're going to go with, because what you would do would be different based on the different scenarios. So, if things were, in those first couple, then, there isn't a huge amount of potential risk perhaps in the system. But as you go down the list, the risks in the system, the potential for bail-ins and bailouts rise. Property prices continue to fall ever more so any assets that are linked to property will probably fall. And of course, the share markets are likely to also tumble in the same horizon as well. That's the other point. It's worth noting that the trajectory on home prices is a sort of a multi-year thing. So if you look at Ireland or Iceland, even 10 years later, they're only sort of just getting back now, whereas the share market tends to react a little more quickly, but it rather depends on whether they will actually end up printing money to try and actually alleviate some of these things. And as John and I have discussed on a number of posts, printing money has its own downsides because it basically just blows up the value of money again. It blows up assets. It kicks the can down the road, but it doesn't solve the fundamental debt bond problem. And as I highlighted right at the beginning, 190.5 debt-to-income ratio, mortgage stress rising, debt rising. We don't necessarily need more debt. So there isn't a simple answer to this. I guess the classic financial advisors commentary would be along the lines of diversification. So you put some over here and you put some over there, and you put some in shares and some in deposits, and maybe even some in gold and what have you, and sort of spread the risks. That may be one strategy. I think a lot of people would recommend that. Not necessarily convinced that that's necessarily the right thing to do. I think the other thing is you need probably to think about liquidity. In other words, how quickly can you make decisions and change decisions? For example, if you've got property and you're trying to sell and you can't sell, they aren't very liquid. Whereas if you've got some other types of assets, then potentially you've got more liquidity. So can't give you a more definitive answer than that, I'm afraid. It's tricky. There are no risk options to do with holding the money that you have. Okay, so yes, I'm Lost said, printing money, passing debt on to our grandkids. Yep, well, that's what we've been doing. So if you look at it for a generation, what we've been doing is effectively building this debt pool, and now it's sitting there, out there, lurking. Younger households have considerably less ability to borrow, to hold assets, to build wealth. There is an intergenerational issue, which I think is worth thinking about. And, we have a bunch of big issues that need to be thought through, which basically means that I think we have to think differently about the problem if we're going to get out of it, and which is perhaps what we'll talk about a little bit later. So are government bonds safe? Moi Moi says, well, government bonds, of course, in theory, are the lowest risk securities out there. And so, the theory is that US Treasury bonds are ultimately no risk. Now, it's interesting that the price of bonds have gone up, which may tell you something about what people think about the risks in the system. It does, to a large extent, reflect the sovereign risks sitting inside particular countries. So I don't think you can say it's risk-free. It may be a little lower risk, but it does depend on circumstances. And of course, there are examples around the world where countries have gone bankrupt and bond holders have actually lost a lot. So. Okay, Genevieve asked, rebail-in, is only one bank likely? What do you think? Big four, second tier, is it the case dominoes falling, or can it be isolated to only one? I think it's a great question. Look, the theory of bail-in it's designed in the situation where you've got a single bank with some difficulty. And basically a bail-in strategy allows that bank to have breathing space to get reconfigured to be able to continue trading. And if you look at the New Zealand model, which is the most transparent model in terms of deposit bail-in, they expressly talk about being able to bail that particular organisation to give them time to restructure, hand some of the money back to depositors down the track, and keep the bank going in some form or in some restructured form. The difficulty is that if the circumstances that's created the bank failure in the first place is not isolated, but it's to do with broader liquidity across the market, then potentially there's a risk there that this may not work the way that we might want. So it's a big deal. I also have this feeling that once you start bailing in and bailing out, you may end up with more and more issues, to the point where effectively it may not be possible to really quite see what's going on. And the problem with bail-in and bail-out that nobody quite knows, it's all quite new. And I'll make the point now, the fundamental switch that's gone on with bail-in is that deposits used to be, I think, regarded by most people as you give the money to the bank holds it on your behalf, and they give it back to you when you want it, right? But bail-in has now redefined what that deposit is. It really is an unsecured loan to the bank now. That's what it is. So effectively, in that scenario, a deposit then becomes, I guess, fair game relative to the other types of liabilities that the bank may be holding. Now, there are other types of liabilities that are more secured, and that basically tells you that, in fact, deposits may actually come off worse than perhaps some of the other structures. And that's the problem. So this bail-in thing is new. It's not fully understood. And just on bail-in, I will make the point that we've had a lot of correspondence from a lot of individuals post our recent post. And it's interesting that a lot of the politicians who've been approached on bail-in are denying that there's any bail-in legislation in Australia, which is tantamentally definitely not correct. It just isn't right. So I've highlighted several times, I don't know whether it's just poor legislation or whether it's actually deliberate. You can make your own mind up. We've gone through the arguments on both sides. But to say that there is no intention to bail in on Australia is not being 100% honest in my view. Okay. So let's have a look. What else have we got? Won't the banks renege on their bonds before their deposits in a bail-in scenario? Well, it's interesting, you see, because this is from the thing about some of those bonds is they are actually different types of bonds. So you've got some that are convertible, you've got some that aren't, you've got some that are secured, and you've got different sort of tiering of bonds. So not all bonds are the same. Demystifying money. Prof. Richard Winner's been saying deposits are simply loans to banks' fees. Yeah, I know. I'm not saying it's new. I'm just saying that now it's being expressed through the bail-in processes. A lot of people don't get that, though. So just going back to the other question, won't the banks renege on their bonds? So I think it depends. You're right, they have multiple instruments. Deposits potentially could be seen as the last resort, but they are also one of the biggest pools of liabilities that the banks have. And the legislation that allows, if I take New Zealand as an example, that allows the bail-in to happen, suggests to me that there could be circumstances when it's quickest and easiest to effectively grab deposits, because if you start reneging on your other bonds, one, you may not get any liquidity from anywhere other potential investors, and two, if you're reneging on, if you like, players who are part of the international financial system, you may actually trigger even more of a crash than perhaps you were trying to alleviate. So it is not simple. Nobody really knows, of course. This is all theoretical. And I think more work needs to be done to fully understand the implications of how bail-ins might play out in practice, because we've only had a couple of isolated examples. In some of those examples, people lost a lot of their deposits. In others, they lost less, they got some back. And in fact, in some countries now, the banking system is now back to more normal, having gone through a very, very severe patch as they try to restructure and manage it through. So, I think I won't go through the whole argument again as to why bail-in is there, other than to say that the previous bailout scenarios, which happened a decade ago, cost the taxpayer big. The regulations and the regulators tried then to put more of the onus on the banks to get their capital up, but also put more onus on those holding the assets and liabilities of the banks, and therefore sharing the risk particularly differently from the taxpayer. And whilst that might benefit taxpayers, obviously it creates risks for the people who actually have funds. And I think you may have seen in one of my earlier posts, we actually described how in New Zealand, the Bank of New Zealand now has a series of data sheets showing each of the main banks in New Zealand and how they stack up in terms of assets and other performance metrics. It's updated quarterly. That's their attempt to try and provide more information to potential depositors, because now depositors in New Zealand are required to trade off and make a decision about which they think is the lowest risk proposition in terms of the various depositors that are there. So not all banks are necessarily equally risky, but in Australia it's harder to get that information. There isn't the same transparency, and even in New Zealand, data that's 3 months old may be too late anyway. So this is a big deal. Okay, I'm going down. What else have we got? Whoops, missed. Hang on. Do you feel the floating the Aussie dollar was a mistake and perhaps would assist the one world economy? And do you see an Australian National Bank printing cash again? That's from Innocent Bystander. Okay, floating the Aussie dollar. Well, of course, pretty much all of the currencies around the world are floated. That was part of the strategies that were done a few decades ago. I think there's a big question to be asked about whether, in fact, those floaty rates have really paid dividends, or whether they've just created more uncertainty and also more derivative type products off the back of being able to take speculative positions. So I'm not totally convinced that floating exchange rates is actually necessarily always good. I guess the point though is that with fixed exchange rates you're locked in, so you have less responsiveness. So the Reserve Bank is able to take some of the pain out of the current situation by allowing the Aussie dollar to slide. And whilst we import inflation into Australia as a result, it means that effectively we can benefit from importing offshore earnings into Australia. That's why the tax take is up, and it also makes our exports cheaper. So that sort of gives us more advantage. So that's why it's done. In terms of an Australian National Bank, yeah, so this is the issue, right? So there is an argument, you may have heard it, to suggest that perhaps we need a different approach in terms of banking, and maybe we need an entity that is focused on productive borrowing rather than just borrowing to stoke home prices higher. And such a national bank wouldn't have necessarily the same profit motive. It would be there to facilitate good economic outcomes. But there is always a risk that they could actually end up just printing cash again. And of course, if you print cash again, then you inflate assets. So it then comes back to how those lending decisions are taken and whether they're actually evaluated on the right basis or not. Certainly there is history shows you that in many cases, even nationalised banks, if they play the same game as everybody else, actually don't benefit. So we'd need a different philosophy and a different mandate if the national bank was actually to make any benefit, in my view. A lot to be done there, I think. Okay, what else have we got? I imagine in New Zealand, a bank with the least attractive dashboard position may have to offer higher rates to incentivize customers, ergo weakening their position further. That's from Don Grant. Yeah, Don, good point. Dan Grant, good point. Yeah. So if you look at the New Zealand dashboard, there was a link on our previous post. I'll put it in the post live version of this as well. You can see there are considerable differences between the banks. What I haven't done is to compare the deposit rates from Bank A to Bank B to Bank C, but given the differences of strength and other things, you would assume that the weaker banks would have to offer higher returns, but then, as you say, puts them under more pressure. So this whole transparency thing is really interesting because it does put the ball back in the depositors' court a little bit. But then my question is, I wonder how many people who look at those tables really understand the data and can make really sensible decisions off the back of it. It's a tough call, right? Because what you're doing now is you're forcing people to try and actually shift from a mode that says all deposits are equal, all deposit rates are equal, there's no risk, to a situation where now we're saying, well, actually some deposits may be more risky than others, that not all deposit-taking institutions are the same, and you need to actually take responsibility and make the best decision you can. That's a big change, and it's a big deal, and I'm not sure that people fully understand the implications of that. Okay. Do you think, this is from Brendan, do you think customer-owned bank like Bank Australia is safer, or is the risk just the same? Very interesting question. So I've done quite a lot of work with some of the smaller lenders in Australia, the customer-owned organisations, and a few things to say. They are less leveraged. They've tended to keep their capital higher. They've tended to actually offer quite good rates because they're not driven by the profit motive, and therefore that gives them more flexibility in terms of pricing and in terms of strategy. However, what they're doing is they're drifting more and more towards having to compete on the same battlefield as the major lenders and the regional banks. So in recent times, I've noticed a loosening of lending standards amongst some of the smaller organisations, and they may not have such sophisticated underwriting standards and processes. So there are some relative risks. But actually, my own view is that some of these smaller organisations, on an absolute risk spectrum, because they don't have derivatives and because they don't have the same need to borrow from overseas, and they have a deposit base against which they actually make their loans, their risk profile, I think, generally would be on the lower side. But you'd have to look at each one individually because there will be a spectrum. There are some that are probably more sporty, some less sporty. But generally, if I was given the choice of putting money with some of those smaller organisations or the big four, I think I'd probably tend to go for some of the smaller organisations, perhaps spread it around a bit. Okay, Martin Burkham says, you talk about bail-in. What's going to happen with the government guarantee of the deposits in the banks? Wouldn't the government take the hit if the banks put their hands on the deposits? Great question. Okay, so this deposit guarantee thing, right? So a few years ago, at the time of the GFC, there was an unlimited guarantee. That was taken away. It's now $250K per institution, per account holder. Now, there's an interesting question. If you've got a joint account and a sole account, are those two or one? I'm not going to go into that because it's complicated. And of course, banks have to pay to actually access this deposit scheme. However, just to remind everybody, this deposit scheme is not active now. That is a theoretical scheme that is activated by the government if there is a need to activate it. The circumstances under which they would activate it are unclear, but you'd assume it's in the situation where potentially a bank fell over. Now, if you argue that the bail-in is designed to stop a bank falling over completely, there is an argument to say that before the deposit scheme was activated, bail-in may happen first. That's just my theory. Never been tested, never been proved. If that's the case, though, you basically would have bail-in first, and then you'd have the deposit guarantee activated only if the bank subsequently failed. The whole idea of bail-in is that you'd end up with a recrafted bank with perhaps some of the risky assets taken away, and therefore end up with a bank that continues. If the bank continues and it can actually ultimately return most of the deposits, the government wouldn't activate the guarantee. So these two things are actually sort of connected, but they're not absolutely joined at the hip. And frankly, if you read all the information on the various websites that there are, it is not clear how the two things interact. But remember that the government is required to declare that they will actually activate the deposit scheme, and that basically deposit insurance scheme is up to a certain amount per institution, and it's up to $250K. But then if you've got bail-in over here and bail-in happens first, you may end up with a different outcome. Okay, so Brendan said joined Bank Australia. Yeah, you know, what I like about a lot of the smaller organisations is they've got a different culture, right? And I did a post about 3 months ago when I actually gave a presentation to the customer and banking organisations, and I said to them, you guys have a wonderful value proposition and a different set of culture. Don't effectively follow the mainstream. You know, go your own paths. It's tough to do, but I actually think that the culture's different and their approach is different. And you know, I've heard a lot of people say to me that they feel comfortable, more comfortable with some of those smaller organisations. Okay, Martin liked the answer. That's good. Okay. David says, in the case of banking groups with wholly owned subsidiary banks, how independently would the subsidiary be treated regarding bail-in? Good question. From a bail-in perspective, it looks to me it will be done at the level at which the bank was actually in distress. So in other words, if it was a subsidiary only that was actually in distress, you might find it was just the bail-in. However, because of the way that subsidiaries are wired into the parent organisation in Australia, and there's a few good examples around where you've got a series of brands but under one curly bracket, I suspect that you wouldn't have a situation where just one subsidiary fell over. It probably would be the entire entity, not least because most of them will manage their funding centrally through a central treasury operation and will be effectively accessing liquidity internationally through a centralised function rather than the decentralised function. Okay. Yes, that's interesting. Genevieve said that Prof. Richard Werner, mid-tier banks are the backbone of the German economy. It's because they print money for productive loans and not asset transactions. Yep, that's true. I mean, they still print money, but yes. It goes back to this fundamental point about what banks are for, right? Banks are not, in my view, there just simply to maximise the returns of bank shareholders by inflating households' borrowing capacity, by lifting home prices and making bigger mortgages and just inflating everything and then turning those back to shareholders. That's what the banking model currently is, and it's broken, right? Banking is about facilitating investment that's required to enable the broader economy to grow and develop. And in fact, banks are less about generating profits in their own right. They're more about facilitating and enabling the broader economy to grow. Now, if that were the case, then there would be some different priorities in terms of lending. There would be some different approaches in terms of the way that the Bank for International Settlements would have set the risk profiles up, because at the moment it's way cheaper from a risk capital perspective to make a mortgage loan than it is to loan to a commercial business. That's just crazy. It doesn't make any sense. So effectively, the way that the central regulatory structure of the banking system works encourages this inflated asset environment that we've seen over the last couple of decades. It needs to be changed. I think Germany is a really interesting example. It's not perfect, but I think the fact that there's a very vibrant manufacturing and industrial sector in Germany, a lot of smaller banks, a different profile also in terms of some of the property borrowing and things. I think there's some interesting things we could learn there. Okay, let me just go back and see. Brenton says, when tracking housing-related data, do you track construction and extension unemployment? Yes, I do. Okay. And do you think that this is the canary in the coal mine? Yes, it is. So one of the things I'm very concerned about is that we've had this massive construction boom. We've got more cranes in Australia, I think, than almost anywhere else around the world. We've got a lot of partly finished high-rise apartments being built. A lot of them rather treatly constructed, as you saw if you saw Edwin's recent discussion with me. The fact of the matter is that we have got a construction sector that's very large, and it's sort of symbiotic with the finance sector, right? But a lot of that is just building these very cheap apartments, high-rise or whatever. A lot of them, though, aren't being sold. And I've spoken to a number of people in the construction sector who actually are building, and they're saying they're slowing their construction, they are slowing their application of new sites, they're slowing their application to buy new land, and they're having to discount deeply the units that they have got for sale, or indeed rent them for a few years and then try and sell them later. This is all about a very important change that's going on. So my view is that we will see construction levels continuing to decline ahead. That means that more and more of the construction sector that's supporting the residential sector will find that they are less employed. And I'm seeing some of that data coming through in my small and medium enterprise data sets. So yeah, I think the construction sector is one of the leading indicators. And remember that if you add up the construction sector and the finance sector and the lending to construction, all of that, around something like 35 to 40% of all the economic activity in Australia is directly or indirectly related to property expansion. Think about that in the context of 40% drops in house prices, failing construction momentum, and you can begin to see the problem we've got. And that's why you either end up with a scenario that says you just kick the can down the road, print some more money, and hope it'll be all right until the next election, or you actually try and tackle it. I believe we've got to get to the point now of tackling some of these fundamental issues. We can't allow this cycle of continued debt to grow. The debt bomb will go off at some point, and if we're not careful, we won't be prepared for it. Okay, what else have we got? This is from, whoops. I get so many new comments come up that the ones shoot up the page and I miss them. It says, it's all right. All those construction workers can easily become computer programmers. Which country should we move to? Well, Australia's a nice country. We just need to get our politicians to work for us more rather than for everybody else. What else? Okay. The only way to save the system is to give the real economy the same leverage as banks to bring them on the same level playing field and make them not too big to fail. Yes, I agree, Kung Fu Joe. I think that's what we've got to. We need to have a reconstruction of our banking system. And, I'm not sure whether the Royal Commission will actually be able to take the lead there. But my own view is that unless we actually do take seriously some of the issues that we've been talking about here and recognise that the current banking system does not serve the population. It serves the investors, it serves the international banking sector and the international finance sector, but it doesn't serve the broad population here. What we have ended up with is many, many households that have debts up to their eyeballs and no ability to repay those debts. And what that means is that unless we can find a way to change the system and reconstruct the system, we will actually continue to languish under this massive debt pile, which, by the way, I think has now got to the point where it's unsustainable and will not be repaid. So it's a matter of the finance sector waking up to that, recognising also that their own conduct has been far short of what it should have been. The Royal Commission showed that. And maybe the Royal Commission will give us the opportunity to jumpstart and restart the banking sector. But I'm not holding my breath and I have my doubts. I suspect that we're going to see probably a more narrow legalistic response to what's been going on rather than the structural issues that need to be addressed, which is one of the reasons why I go back to my scenarios. I'm trying to get people to understand that there is a broader conversation to be had. It's not just about the bad culture in the banks. It's not just about, a few bad apples. We have a structural issue to address here. And by the way, not just here, but around the world as well. Pete Mitchell, when are you going to start wearing a leather jacket? Alice Steve Keane, I assume you mean, Pete. Well, yeah, I have to say that I think I'll probably pass on that one. You may have seen Steve Keene's interview with that I did with him 6 weeks ago about Are Icebergs Fluffy? If you've not, it's worth watching because Steve was very honest about his call, which was that home prices would drop. And he said he underestimated the government's ability to continue the bubble for longer than ever. But he still thinks he's right, and I think he's right. I think we're now seeing it coming home to roost. So he's right, but the timing was wrong. Okay. What else have we got? Lots and lots of questions which haven't got my walk the world, so I'm just ignoring them. It's just that's the way it is. Yes. What else have we got? Okay. All right, so there were a few questions that people had asked me prior, which I'll just try and address now. So one of the questions was, what about these exchange-traded, the ETFs? How do they work in a bail-in situation? And what about superannuation? How does that work within a bail-in? The short answer is it's tough to know at the moment because it's not clear. A superannuation fund, of course, is a separate legal entity. So you'd think that it could be regarded as a commercial entity rather than a individual holding. And as I understand it, the bail-in is more to do with personal deposits. But to be honest, it's not totally clear the scope of the bail-in. So could they also bail in commercial deposits? Could they bail in superannuation? I can't give you a clear answer than that. And with regard exchange traded and the ETFs and those sort of things, there it depends on the ownership structure and who's got them, who owns them. Remember that a lot of these are actually owned by the large financial organisations directly or indirectly. So if they're those that are actually affected through a wholesale a platform. So again, very complicated, very difficult to know whether they are more or less risky than some of the other types of entities that are out there. I think the way I think about it is that pretty much across the board, whether it's from deposits, whether it's from holding bonds, whether it's from shares, whether it's from the exchange traded options, those sort of things, they're pretty much all risk on at the moment, and that's the problem. There is no risk-free solution. And by the way, gold and silver, in my view, and John may have a field day here, I'm not sure, but in my view, there are risks attached to those as well, not least because the price of, for example, gold is, I think, artificially low at the moment. It may change later, but who knows? And of course, there is always the risk of the government knocking on the door and saying, right, we're going to claim our gold back as we can under that 1950s Act. So it's all very complicated. No real super safe options, I'm afraid. Okay, Nobby has a good question. Okay, how would a bail-in affect an offset account? Okay, so in the list of types of accounts that are actually included in the deposit insurance, the offset account is mentioned. In terms of bail-in, I suspect the right of set-off would probably take precedence. In other words, the bank would say, you've got a loan over here, you've got a deposit there, so you net one off against the other, and the net amount is effectively what's there. But I can't guarantee it because there's nothing absolutely in black and white. And I've made a few inquiries with a number of the banks about the set-off situation, and frankly, I have got very, very unclear responses from them. In some cases, they refused to answer. In other cases, they gave me an answer which, frankly, I find very, very difficult to really decode. And it's a bit like the politicians. If the asked the politicians, is there a bail-in approach in Australia? The answer is no, of course there isn't, despite the fact that I think there is. I think the same is also true with this, that the offset situation is unclear, but I think the right of set-off will probably take precedence. Okay, question there. If you had access to a guarantor and a deposit, how long would you wait to buy? Or would you build on parents' spare bit of land in the meantime? In other words, increase the value of inheritance. Oh, wow. Now, that's an interesting question. The question, I think, ultimately is what's going to happen to land prices and property prices over the next 10 years, right? I've given you an indication that I think they're likely to go down and stay lower for quite some time. Look at Ireland, look at Iceland. So there's probably not a whole lot of capital gain from just holding the existing, land or thing. Now, you can add value to it, I guess, by taking the land and putting something on it. But I think we've got to get to the point where we see that property is not just about speculative, asset growth. It's more about finding somewhere to live. So my theory is think about property as providing a shelter, as somewhere to live, and if you happen to get a bit of capital growth later, then that's a bonus. Don't think of it the other way around. But in fact, I survey still most people start by saying that property is seen as an asset which will grow wealth. We may have seen the end of that for at least a generation. So that's my perspective there. Okay, next question. Okay, Peter wants to know, who played the drum beat in the DF intro? Was it you? No, it wasn't actually. It was done by a composing program that I have. So basically, I just picked up one of the drum beats, put a few chords to it, again and just wrote it. So it wasn't actually played live. And I've had lots of comments about my intro. This is a complete aside, but so some people say, "Oh, it's very old-fashioned. You should get something a bit more upbeat." And other people say, oh, I really like it. It's a bit different. And so, I don't know what you think, but I've been using it since I started a few years ago, and haven't got any immediate plans to change, but perhaps I will later. But anyway, so yeah, it's a computer program. Okay. Now, let's have a look. If the RBA doesn't raise rates, our retail banks will be forced to do so as their funding from the global markets will be more expensive. Yeah, correct. So that's from Slavmark. Yeah, so we are definitely seeing pressure on bank funding. We know that they've lifted their mortgage rates by, 11, 12, 15 basis points. That's not enough to cover all of the costs from the international funding. So expect, I think, to see more out-of-cycle rate rises. Expect to see more differential pricing. And what's happening, of course, is that if you are caught in a loan with effectively less good credit quality now, and a higher loan to value ratio, and lots of costs of living, and therefore a little spare cash, you may find it hard to refinance. You may be effectively locked into that higher rate mortgage. Whereas if you are a low risk borrower with very, very clear credit and clean credit, you may be able to get some of these amazing deals. So what's happening is lenders are desperate to try and find those low risk refinances. They'll get very low rates, whereas the others will actually have to pay more. They're mortgage prisoners, and about 40% of loan refinancings are still being rejected at the moment, according to my latest research. So it depends on where you are and who you are, but I think it's certainly the case that we're going to see considerable funding pressure on the banks, and they've also got this massive additional cost now relating to the remediation from the Royal Commission and all the other things I mentioned earlier on. It's more than $1 billion, well over that now. That's a big number. That's going to have an impact. And so a question will now be whether that translates to lower dividend payments to the investors, including institutional investors here and overseas, or whether they will actually seek to claw back that by lifting rates. And in a way, I keep asking the question, who pays at the end of the day? Unfortunately, I think it's you and it's me, because standard bank users ultimately will end up paying and picking up the bill for all these. The executives and the senior managers in the banks, I think, are still getting off scot-free. I haven't seen any real evidence yet that there's a real change of tune and attitude. There's a lot of lip service. Massive re-engineering job to be done in the banking system, and I guess my question is, are the bankers who are there up to the job? Many of them, I think, aren't. Okay, John Adams. Armageddon is a 100% probability. Yeah, so John's got this view that, like us or not, we're going to end up, in the bottom end of my scenarios, right? Down at the bottom end. And essentially, that's because effectively the die is cast. I'm sort of a little more optimistic, saying I still think there's a bit of a chance we could extrapolate a different path if we're clever and if we're smart and if we start acting. But as time passes and as the debt bomb continues to build, it becomes more and more likely that the only way out of this is going to be considerable pain, be it Armageddon or hell on earth. Damien Wright, when do we meet your dogs? When do we get to meet your dogs? Well, they're both asleep at the moment. They're actually over the other side of the room there. Of course, it's dark now, and they go to sleep when it gets dark. So I'd have to run the live stream session earlier in the day or make a recording. Perhaps I'll make a recording about the dogs. John Adams, you're good comedic value, but don't be sold on Australia's complete demise. A pullback will happen, but not an apocalypse for a while. From Stuart. Yeah, well, I think you're saying what I'm saying. It's not, there are going to be different views, right? What I think we have to do is we have to be debating this stuff and talking about the different scenarios rather than just, rolling over and saying everything's fine, because I don't think everything is fine. Okay, what else have we got? So, yeah, the Aussie dollar is toast, somebody's saying, yeah. Whoops, what's that? If households want to be their own central bank, and accumulate gold. What's to stop the RBA Treasurer activating Part 4 of the Bank Act 975, making gold holdings illegal? Interesting question, John. That's one for John. I can't answer that, but perhaps we'll probably do another one on gold. I don't know whether you saw, but we actually did the other day. Put it up today. In fact, the next part of the question of the gold and where it's gone. I think there's more to say on that. So if you've not seen that one, have a look. It's really quite funny. John got really quite heated when we recorded it last night. I'm just having to change my switcher here. It's gone off line. It's better. Yeah. So have a look at that. You might be intrigued, but I think we're going to come back to that. Deleveraging is baked in, says Brenton. Yeah, probably right. Stuart says, looks like Morgan Stanley has finally become more realistic with their predictions. Yeah, well, so they're talking now 10 to 15%. So they're talking business as usual. Going back to my, going back to my scenario. Just put that back up for a second. Yeah, so they're talking 10 to 15%, which is the business as usual one. They did say there is another scenario that they've got, but it's not the central scenario. So that's what more of them are doing now. NAB was less than 10 to 15% in their latest review. But the fact of the matter is, most of the mainstream economists are still talking historically based on looking back in the rearview mirror rather than trying to see ahead. And what I've tried to do in this modelling, as I showed you earlier on, is to take all the data that I've got and then extrapolate it forward. So I'm probably forward looking further than even the likes of Morgan Stanley. So that's my perspective on that one. Okay. Where do you think BTC will go considering all these economic wars in the world? Interesting question. So Bitcoin, I can give you two scenarios for Bitcoin. The first one is that it's going to continue to languish around the level that it's been languishing for some time, that effectively it will continue to be a relatively high-risk speculative entity that will not have a huge amount of momentum into the future. That's one scenario. The other scenario is it becomes more mainstream, it becomes effectively a replacement for gold, it becomes essentially the foundation perhaps even of a future currency, right? Somewhere between those two scenarios is the truth. And the difficulty is to know which of those two truths are actually likely to play out. Now, we know that some of the mainstream international banking groups are more and more actively looking at Bitcoin in terms of, offering trade in Bitcoin and those sorts of things, or custody of Bitcoin, those sorts of things. We also know that there are alternative structures to Bitcoin, for example, digital currencies that are actually backed by reserve banks around the world rather than actually owned privately. So there are all sorts of different futures. In fact, there's a post I did about 3 months ago that explored all these different scenarios. The difficulty I have is it's very tough to call at the moment how this is going to play out. And if you look at the trends in Bitcoin over the last little while, it's gone sideways. It's not really gone up. It's not really gone down. I suspect we're going to see more of that sort of sideways move for the next few months. But if the US economy goes off the boil, and if in fact interest rates rise, and then perhaps there's going to be some reaction to that, we might see Bitcoin react. But I also think we might see gold react a little. But then I also think that the gold price is being controlled a little bit too. So hard to know. Okay. This is from Michael Patterson. Great debate as usual. Thank you. We hear a lot about household debt. Any idea the debt levels across businesses? Is it the same story? It is in some businesses. So about half of businesses don't borrow. That's the first thing. I'm talking small businesses here mainly. So they prefer not to borrow at all. Of those who are borrowing, about half of them cannot get the finance that they want because they cannot jump over the hurdles that the banks have put on in terms of security or in terms of other information. Of that remaining quarter, the people who are borrowing, a lot of those are very highly leveraged at the moment, and certainly if I look at the equivalent of mortgage stress in the business sector, some of those are actually quite close to the wind. and they are very much impacted by even small interest rate rises. Now, one of the things that's not talked about very much is that, in fact, the costs of business finance have been rising relative to even mortgage rates, and the banks have been using effectively the business sector to cross-subsidise some of their other businesses. So some of those businesses are really now up against it, and at a time when business confidence is beginning to dip, when momentum in the economy looks like it could stall. So I'm quite concerned about some of that business sector. And I go back to my earlier point, there are a lot of businesses who want to borrow but can't borrow, and some of those probably should never borrow because essentially they perhaps don't have the ability to be able to make their businesses fly, but many who could are not able to get finance. So it's a very mixed picture. I'll be publishing a report later in the year on the SME sector, and I'll let you know when it's up and available. Okay. Okay, Alan M. Do you think the effect of bail-in would be, what do you think the effect of bail-in would be with regard to company or superannuation accounts? As it's hard to know, as I think I said earlier on. At the moment, there's no clarity about what types of deposit accounts are actually bailed in. So if you've got money in a bank in a superannuation account, there's nothing in my mind to suggest that it would be handled differently. But if you had money in a superannuation fund that was managed by a bank but was in the market, then I suspect it would not be caught. So I think it depends on the structure. So that's the best I can do on that one, I think. The problem we've got is we don't have enough information, and every time I try to ask people about this inside the various regulatory bodies, we get stonewalled. So we're still asking. If we get more information, we'll be the first to share it. Okay, if you have an Iceland 2 or worse, and one has come out of it very well, what sort of businesses would be good to acquire? That's very interesting. So there are businesses that are actually set up, I think, for the future, much more perhaps digitally aligned businesses, perhaps those that are actually doing new and different things. But I also think there's a place for manufacturing. And the thing that I'm amazed about is that we seem to have given away the fundamental economic driver that Australia had. So we dig up stuff out of the ground and ship it overseas, and we do construction and we do housing, and that's about it. There has to be some diversification, I think, and that's why a public owned bank that made investing decisions differently would actually be quite powerful in terms of perhaps creating some new opportunities. There are some really entrepreneurial people in Australia with really great ideas. And you talk to them, as I do quite often, about the inability they can of getting the funding they need to take that idea and make it come alive. So I think there are lots of business opportunities and ideas out there, but we need a different innovation engine to be able to harness them. Okay, somebody, Alan Evans, surely taking money from companies' businesses would be bad for the economy. Yeah, that's true, it would, but you could also argue the same for households as well. As I say, I don't know. It is not clear in the very fuzzy legislation as to what's in and what's out. They just talk about the bail-in of any other instrument, and any other instrument could be pretty much anything. Steve R says, whoops, missed. Hang on, I've lost it now. Is commercial property that leveraged? And do you see a danger there? Absolutely, yep. So there's a lot of leverage in commercial property. You may have noticed that some of the banks have stopped lending to some of the commercial property investment portfolios that are there, and indeed some of the construction sites. Some of them are finding it difficult to get funding. And in fact, some of the reporting season recently, they showed the distribution of construction. For example, Bank of Queensland, they actually showed the number of commercial sector sites that they were actually supporting. Watch that space. I think as the demand for property eases and as the whole question about the cost of funds rises, the commercial sector could be another leading indicator to what's going to happen later. In my modelling, I do actually have some data on that. Okay. Okay, what else have we got? Right. Time for a cup of tea. Yes, that probably is. We've done a good 9:14. So what I'm going to do, I'm just going to come back now to this other slide set, and I'll just round off the last few slides that I had here. Can I just, for a second, talk about Patreon? Because we had 49 new patrons in the last month. Thank you very much, 132 now. I cannot underscore how this makes my life easier, because basically I can spend more time building content, interviewing people and putting stuff up if I'm supported via Patreon. It's now enough to be significant in my business, which means that I can do less other work and I can do more of this. So if you like the sort of content that you see here and would like more, then if you're not a Patreon supporter, Patreon is there. It's not perfect, but it is a way of being able to support what we do. It is appreciated, and you can. There are a couple of tiers: the sort of the basic tier where you get to help us, and the higher level tier where you get access to some additional content, some extra reports, and some other things. And there's more planned ahead. So just on Patreon, it's quite important to help us run what we do. And then just some top hits. This is just a quick summary of things that you may have seen. So the Edwin Almeida one that we did yesterday is worth looking at. It talks there about some of the issues relating to investment properties, poor construction. He's a bit of a property bear, but he's in the industry, so worth listening to him. There was the one that John Adams did about Australia's missing 11 tonnes of gold. And tonight we posted another one on the other gold that the English may have been messing with. Our weekly, of course, Property Imperative comes out each Saturday. That is a very popular one now. It goes wide and far. We have lots of viewers now from overseas who actually look at that. And we try to get the balance between the local and international and the property and the finance. The post on bail-in, we'll do more on that. We've had a lot more information from other people since our last post. People have shared privately information which we don't make public, but the messages we are absolutely going to make public, particularly around the issue of what some of the politicians are saying with regard to bail-in. There was the Robbie Barwick Vision thing one, which was about how to make our banking system and to make Australia great again. If you want a bit of inspiration, it's worth watching that. And there's also, if you want the other side of inspiration, which is depression, mortgage stress, that's one of the ones there. So those are all things that are there. And I'm just looking now last for any other any other things going on. What the chances of setting up an interview with a real estate agent? I've got a couple in the works. There is somebody I'm talking to tomorrow who's very much in the sector. I'm trying to get some others. A lot of the property bulls refuse to talk to me about. I mean, you know, Stephen Koukoulis being one of them. I did suggest he come and debate his position with me. The factor there is that it's a bit of a problem to get some of those guys to come and dance. I also noticed that a couple of people have said, what about alternatives to Patreon? I'm looking at it. It is quite complicated to make alternatives, but I'm looking at PayPal as a potential alternative. It's just a bit tricky to set up, but watch this space. I'll see what I can do. I recognise that Patreon's not perfect, but actually it's still not bad. Should we take our money out of the banks? No, I don't think you should necessarily. I think you need to be aware, right? Be aware, be alert, keep an eye on what's going on, keep an eye on this channel, because we can tell you a little bit what's going on. This isn't going to fall over tomorrow afternoon, I don't think. It's going to be a long, slow grind. But what I'm trying to do with the DFA site and with John's help is to basically help people get information so that you can make decisions. Because I can't make decisions for you. All I can do is to tell you the sorts of things that I'm seeing, give you my experience, and provide you with some of the tools to be able to make decisions. That's sort of what I'm trying to do. Now, Debbie asked about, are you going to have a lawyer as a guest to ask about the federal banking laws? I'm trying. It's really tough. It's really tough to try and get lawyers to come and talk about this stuff. Now, my wife's a lawyer. She's not able to talk about this stuff, not in her area. But, it's tough. I'm trying. I'm planning a whole bunch of future guests. I'll plan to do some more with the guests who've been on before, and Many of you have made other suggestions. I'm chasing some of those down. It's a matter of capacity and, you know, limited resources and everything else. I'm just going to switch back. Okay, so I think we're pretty much coming towards the end. I'll just have a last look back through. Do I see the Aussie dollar falling to lows of 50 cents? It could indeed. The question is, the Reserve Bank will probably allow it to slide to a certain extent because it will actually protect the economy to an extent. But effects, they are essentially sacrificing some of the, you know, the economy as a result. And remember that we are importing a lot of our fuel. Cost of fuel is very high. We're importing a lot of the cost of funds because banks are borrowing from overseas. So if the dollar goes down towards 50, that's a huge impost on the banks and on everybody else. Okay. Anything else before I go? Could I do a video on how the construction sector fared in the deterioration of other property bubbles? Yeah. Looking at that, good question. We'll certainly add it to the list. And I see there's a few other ones that are actually being suggested in terms of people to talk to. Some people say yes, some people say no. Okay, very interesting. It's quite fascinating when you actually talk to people about particular people. You know, for example, I did an interview with Harry Dent, and some people loved it, and some people actually hated him. So if you're a Harry Dent supporter, by the way, it is news that he's coming to Australia next month. John Adams, I hope to do an interview with him when he's in Sydney, and he's also going on a speaking circuit. You can actually get some free tickets. If you're interested in those, just go across the DFA site and you can get some information there as to how to get those free tickets. So that's give John Adams a pay rise, but pay it in gold. Oh, there's an interesting question. And Daniel says, go to the change.org and start a petition there for the Royal Commission. Okay, interesting question. Pete Silver, why don't you get a Bitcoin address for donations? A few other suggestions about who else would come on the channel. It's worth listening to people you hate sometimes. I agree. And by the way, I try to get people with diverse views that come on the channel. I don't necessarily agree with everything that everybody says, but it's a good format for debate and sharing knowledge. And frankly, that's what I think this is mostly about. So I think we're pretty much there, running out of steam, running out of comments. Apologies for not showing those slides earlier on. What I will do is I will put the slides in the alternative version so that you can actually see the slides if you want to. Most of the slides actually you will have seen and will be seeing in other videos shortly. We have a sort of strategy in terms of continuing to put more information out, one a day through to the end of the year. I will then review how frequently I make posts once I've reached the end of the year. But I've been very grateful. We had more than 2,000 new subscribers in the last month, and we've had more than 519 peak concurrent on the stream tonight, which is a record. So thank you all very much for taking the time to spend the time with me. If you have comments and questions, feel free to send them in. I haven't answered all the questions that people ask me. Sorry about that, running out of time, but I will take them down and we'll actually endeavour to add them in the next videos. Look out over the next few weeks for my next edition of the one on the capital markets. Edition 2 is coming out of that. We're going to be releasing our 6th monthly report on the property imperative, which is effectively a summary of all the work we do. And we're going to continue to do some work with John Adams around gold and other things. I think it will be a lot around gold because, you know, as you know, John is very interested in what happened to our gold and what happened in the UK. So have a wonderful evening. Thank you very much for spending the time with me, and hope to see you next time or on one of the other channels. So I'm going to sign off now. Hopefully if I push the right button, see whether it works. all being well, have a good evening.